Well, folks, it's that time of the year again where annual reports are released to show how investors fared in 2021. And as to be expected, there was a lot of growth in financial markets in 2021. But yet, a huge portion of investors underperformed in nearly every asset class. Well, in today's video, I'm going to show you why this was the case and what you can do to remedy this underperformance. Let's get into it. Judging how well your investments have been performing is all about relative performance. For instance, I've been hearing a lot from retirees that they feel like their investment portfolio has been doing very well over the last decade. After all, it's been growing pretty significantly, and therefore their advisor has been doing well to grow that portfolio. Well, as an investor, it'd be very difficult to not do well over the last decade. After all, the S&P 500 has grown over 460% over the last decade from 2012 up to 2022. And so as an investor, you need to care about relative performance. So for instance, if you've been investing in large cap stocks and over the past decade your portfolio has only doubled, well, you've actually been doing pretty poorly on a relative basis. The report that I look to each and every year to track both investor performance as well as fund performance is a report called the SPIVA Scorecard. This is a report that's released by the S&P indices. It's been around since 2002 and essentially tracks fund performance relative to its given benchmark. Now, the data in this report is quite eye-opening, and we're going to get to that data here in just one second. But there are a couple of reasons that I want to cover first for why this report is so valuable to investors. First off, the SPIVA Scorecard weights data based on size. So let's look at an example of we have one mutual fund that has $10 billion in total assets. We also have another mutual fund that only has $10 million in assets. Well, in the SPIVA Scorecard's data, Fund 1 will have a much larger weighting inside of the data of outperformance or underperformance than Fund 2 will have. A second important thing to note here is the SPIVA Scorecard's data corrects for something called survivorship bias. And this is extremely important because oftentimes we see survivorship bias included in data. Now, to explain what survivorship bias is, let's say that we're sitting here in 2010. And let's say 5 new mutual funds were just released. Now, in this hypothetical example, we're going to say that over the next 10 years, the index is going to grow 350%. So that's the benchmark. Now, on the screen, you can see how each of these 5 mutual funds fared. We had one mutual fund that outperformed the index. We had 2 mutual funds that were right in line with the index. And then we had 2 mutual funds that greatly underperformed the index. Now, oftentimes, a mutual fund company will shut down the 2 worst performing mutual funds. The reason being is because these mutual funds have a fairly poor track record, and therefore, not a lot of investors will be flocking into these mutual funds over the next couple years. In fact, they will probably be leaving these given mutual funds. Well, now we introduce this idea of survivorship bias. If you're someone sitting in 2020, 10 years later, and you're looking at this mutual fund company, their track record looks pretty good. They had 3 mutual funds that either performed right in line with the index or even outperformed the index. That's only because we don't see the 2 mutual funds that were shut down. So if we're looking at this mutual fund company, we want to make sure all of these mutual funds are included in our assessment. And the SPIVA Scorecard does just this and corrects for this survivorship bias. The final thing to note here is the scorecard compares apples to apples. And this is another important consideration that I often find is left behind. So there is a relatively famous American funds ad that drives me absolutely nuts. You'll see this ad on the screen right here. And basically what it does is it compares 5 American funds to the S&P 500. Now, the reason this ad drives me nuts is because it's not a fair apples to apples comparison. Let's take the top performing mutual fund that they show on this chart, the Growth Fund of America. And when we look at, let's say, something like the S&P 500, and we look at the style breakdown of the S&P 500, we can see that it's a large cap blended index. Now, when we look at the style breakdown of the Growth Fund of America, we see that it's not the same at all. We're not comparing apples to apples because the Growth Fund of America is primarily a large cap growth oriented investment fund. And so when we look at a more recent history of the Growth Fund of America versus the S&P 500, we see that the Growth Fund of America does outperform the S&P 500. But that's because growth investing has been doing quite well over the last decade. But when we compare the Growth Fund of America to a growth index or a growth index fund, we see that the Growth Fund of America actually underperforms. And so the outperformance of that graph from American funds is because of comparing apples to oranges, not apples to apples. And the SPIVA Scorecard corrects for this and compares growth to growth, value to value, and so on. And so the SPIVA Scorecard is essentially going to compare funds like an actively managed mutual fund to their given benchmark. And the good news for investors here is that there isn't a ton of room for gray area within this data. In fact, the data is fairly black and white. It is very difficult for funds to outperform their given benchmark. On the screen, you'll see a table that compares quite a few different US-based asset classes, everything from large cap stock funds down to real estate funds. And what's interesting is on a shorter time frame, there are certain sub-asset classes where it looks like it may make sense to pay a mutual fund manager. For instance, over the last year in large cap value, it looks like 62% of fund managers outperform the index. But remember, we're long-term investors, and when we extend out this time frame to 15 and a 20-year time horizon, we see that in every asset class category, 80% of the funds underperform their given benchmark. And this isn't just the case with US-based funds. When we extend this out to international stock markets, we see the same dynamics play out. Over a long time horizon like 20 years, over 85% of fund managers underperform their given index. The same thing plays out with bond funds as well. Once again, we see the same dynamics. Over a long time horizon, fund managers often underperform the given index. Now, as a viewer, you might be saying to yourself, sure, but growth isn't the only important piece here. Oftentimes, people might give money to a fund manager because they expect to get a certain level of growth, but take significantly less risk. And so now we introduce this term called risk-adjusted return. Now, unfortunately for mutual fund managers, the results get significantly worse under this risk-adjusted return lens in nearly every category. So based on this data, it seems that fund managers are actually taking more risk to earn less return. So we're losing on both sides there. Now, the final data point that I want to share with you is just how much these funds underperform their given benchmark. So it doesn't matter that they underperformed, what matters is by how much. US large cap, US mid cap, and US small cap funds on average all underperform their given benchmark by over 1% per year over the last 20 years. Real estate funds also underperformed their given benchmark by almost 1% per year. International funds saw consistent underperformance as well. Now, performing 1% less per year doesn't really seem like that big of a deal, but over a long enough time horizon, because of compounding, it can actually be a very big deal. Going back over the last 10 years, if you would have invested $1 million in the stock market, but performed 1% worse, that would have cost you $385,000 over a 10-year period. And so what can an investor take away from all of this data? Should we just simply be owning the S&P 500, just own the given index, and not really make any decisions beyond that? Or should we just invest in a classic 60-40 portfolio? Just because the overwhelming majority of fund managers can't add value or haven't been able to add value from a fund management standpoint doesn't mean that there's no value to be added from an investment management standpoint. On a micro level, we shouldn't expect to outperform a benchmark by picking a superior mutual fund manager or by investing in individual stocks. It's very difficult to pick individual investments that will beat the overall broad index. I believe the edge in investment management today comes from portfolio construction. So for instance, let's say that we have 10 asset classes that we want exposure to or we're thinking about having exposure to. Well, what is the right mix for our situation in each of these given asset classes, both for our goals as well as for our risk tolerance? If we're a retiree who's delaying Social Security and we're taking 6% from our portfolio, we should have a completely different asset mix than someone who is fully pensioned and on Social Security and is taking nothing from their portfolio. If we have one investor that can't handle losing anything from their portfolio and one investor that can handle a ton of risk, those two investors should also have a different portfolio constructed. Finally, I believe that asset selection is an additional area of portfolio construction that can add to long-term performance. So for instance, in this high inflation, low interest rate environment, how will you add safety? When bond returns are losing significantly after inflation, we've found that some investors have had great success with looking at alternatives relative to bonds. But even with all of this, it's important to understand that in the forest of retirement planning, investment management is only one tree. Now that's one tree that the financial media loves to talk about ad nauseum, but nonetheless, it's still only one tree, and it's one tree that we can really only affect so much. There are other areas within your retirement plan that we can affect in a lot greater way. Things like your tax plan, optimizing your Social Security filing strategy, designing an income plan that perfectly fits your goals for retirement. In fact, I think too many investors try to focus on outperforming the market. And as we've seen with the SPIVA Scorecard, this is extremely difficult to do. And in the pursuit of trying to outperform the market, I think many retirees miss out on the single most important thing they should try to obtain. Click on this video right here to see what I mean. Sometimes with retirement, it's not only about the numbers, because retirement isn't just a numbers event. It's also a life event. Again, click on this video to see what I mean, and always remember, you don't need more money, you need a better plan. Thanks for watching.